You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is time once again for TWIFO, This Week in Futures Options, a program where the title pretty much says it all. We break down the week that was and indeed still is. From a futures options perspective, going to look at the OI, the volatility, the skew, what the hot trades are, all sorts of fun stuff, and a whole bunch more. What's going to make it on the show? You never know. That's why you have to tune in every week when we break down what's moving and shaking out there on CME Group. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we think so, Options Insider Radio Network. Reminding you, of course, you can continue to enjoy all of our shows on demand on just about every platform under the sun. If you want to go above and beyond, get access to the live as well as the exclusive shows that we do out there, the pro Q&A sessions, and, of course, our Options Oddities every Friday. Go above and beyond. Check out the pro, theoptionsinsider.com/pro. And, of course, however you listen, live after the fact, make sure you keep sending in those questions and comments. We do love to hear from all of you folks out there. Let's see who we're hearing from today. Holding down the CME Group hot seat is a newcomer to the program and indeed to the network. She is CARLEY Garner, the senior analyst and broker at DECARLEY Trading, also author, I should say, of a few commodity options tomes, including Trading Commodity Options with Creativity, Higher Probability Commodity Option Trading, and a trader's first book on commodities. CARLEY, welcome to the TWIFO program.
Thank you. It's my pleasure.
Well, CARLEY, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give our audience a bit of an overview of your background in the world of futures options, as well as what it is you do day to day over there at DECARLEY Trading.
Okay, so DECARLEY Trading is a futures and options brokerage service. We are what you might call a boutique shop. We're not huge. We're not one of the big shops that has a million people working for him and so on and so forth. We're a smaller shop, but what that allows us to do is offer a very specialized service. So we actually cater towards option traders and specifically option sellers and spread traders. A lot of brokerages don't allow clients to sell options, whether part of a spread or not. And we do. I mean, we have been doing this for a long time, so we've got a better handle on how options work and risk management and things like that. So we're able to offer span minimum, exchange minimum margins for strategies that a lot of brokers won't even allow to take place on their brokerage. So that's where we come in. I've been in the industry since early 2000s. I was actually just doing the math yesterday. It's coming up on 20 years in the business, which, wow.
It sneaks up on you, doesn't it? It just creeps up on you. All of a sudden, wait a minute, I've been doing this for 20 years.
Yeah, I mean, I'm not quite there yet. I'm about 18, but man, what's 2 years after all of this? And I can tell you every single day I learn something new. This is a wild industry. I mean, just when you think you've got the key, trust me, something changes and the markets humble you. So it's been interesting.
It's crazy times. This January, it'll be 15 years for our network alone. So yeah,
Whoa.
Crazy times afoot here in the land of all things fun podcasting. As we keep on rolling, you know what time it is, listeners. It is time for the movers and shakers.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody. Welcome to the Movers and Shakers Report, the portion of the show we break down exactly that. What the heck has been lighting up the tape to the upside, a.k.a. the light side, and to the dark side over there at CME this week. And CARLEY, as our guest, I will give you the pride of place. Where should we begin our journey this week? To the light side or to the dark side?
Well, let's go to the light side.
Okay. I like it. I like what you're putting down there. We can do that. Interesting week this week on the movers and shakers. We got some big movers, but not a ton of heavy options hitters, which is interesting. So let's get into that. Number 5 on our light side this week. By the way, it cost you a little over 4% to break into the top 5 this week, listeners, on the light side. I get 4.14%. To be precise. That gets you to the S&P Mid-Cap 400. By the way, listeners, you guys, as always, can get access to the Movers and Shakers report yourself. The folks at CME always tweet it out right before showtime. We retweet it. So if you follow either of us, you should get access to it there. You could check it out for yourselves. You'd see that it's a pretty evenly split week. An interesting week out there. Number 4, we have our old friend, once again, a frequent offender. The Nikkei, the yen-denominated Nikkei out there, up nearly 5%, 4.93%. It was number 5 in the same direction last week, up 5.39%. And once again, not really an options player to speak of out there. Number 3, live cattle. Also not a huge options stalwart, 5.56% to the upside this week. Number 2, our old friend, the Russell 2000. Man, have you seen the move small caps have had this week, listeners? Huge, up 5.63%. They've been outpacing pretty much every other equity. Something, the catalyst is on fire out there. Is it the second wave? We saw a big wave of upside action in small caps earlier in this year, and certainly hot on the heels of this time last year, hot on the heels of the election last year. So maybe November is just kickoff time. In fact, we did have Mr. Russell Rhodes on the show not that long ago saying there is an interesting Santa Claus rally effect that goes on with Russell towards the end of the year. So he did mention there might be a rally coming in the near future, and looks like he was on the money with that one, up 5.63% this week. It was number 12 in the other direction last week, off about 0.5%. So not much going on last week. And our number 1 mover to the upside this week is oats, up nearly 7%, 6.93%. It was number 2 in the same direction last week, up 8.25%. And again, you've asked us before, not really any options to speak of out there on oats. So intriguing stuff. Now to the dark side we go. Number 5, copper, off 1.78%. Was number 3 in the same direction last week, off nearly 3.5%. One of the few real options players at all really on the dark side as well. Again, kind of an interesting week. Number 4, the peso. We don't see FX breaking into the movers and shakers too often, off 2.17%. And we all know once you get outside of Euro USD and maybe a little bit of pound USD, the paper in the FX falls off a cliff. And unfortunately, the peso falls into that category as well from an options perspective. Number 3, rough rice, off 2.3%. We had someone asking about rough rice on our Pro Q&A just this week with Virginia McGathy, our ag specialist over there at McGathy. And Yeah, it's an interesting marketplace. Unfortunately, it's kind of a trade by appointment from an options perspective. So again, a challenging one for newcomers. RBOB number 2, going back out to the energy, off 2.49%. And number 1 with a huge bullet, even if, again, not really an option story at all, iron ore back in our movers and shakers this week, off 18.53%. So, CARLEY, we've kind of covered the gamut there of all sorts of different products and areas and complexes. Unfortunately, not a lot of them are big options players outside of, let's say, the Russell 2000 and maybe a little bit of copper and a couple others. So the way is kind of open this week. We can begin wherever you want. So what product is lighting up your tape and catching your eye this week, CARLEY?
All right. So honestly, we've been battling natural gas for about a month and a half now. So
nat gas.
Oh my goodness, been quite the ride.
I think we can make that happen. All right, so let's head out to energy first.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everybody, welcome to the energy complex. You guys know where to find these reports for yourselves. CMEgroup.com/TWIFO, TWIFO, or /TWIO, TWIO. Both of those should work. Both of those will get you to our This Week in Futures Options reports. Again, these are live throughout the week, so you don't have to do it just at showtime. You can run these whenever your heart's desire. If you want to check nat gas at 2 a.m. on a Saturday, no one's going to judge. Head on over there. Run these reports for yourself. By the way, if you want to find nat gas, listeners, where we're hanging out first, go to that asset class drop down, scroll down to energy. You'll see nat gas right below crude oil there. Click on that, and you'll be off to the races. So, CARLEY, this is not a surprise. Nat gas has been lighting up our movers and shakers. Weirdly enough, this is one of the few weeks where it hasn't been on our movers and shakers, which is interesting. Sounds like it's been burning up your tape over there at DECARLEY as well. What's been catching your eye? What have your customers and clients been up to out there in this rip-roaring nat gas market, CARLEY?
Sure. So to be honest, I fully understand why it isn't showing up on the weekly hot cold list. And the reason being, like, we've had some really big intraday moves, but ultimately we're actually right kind of in the middle of the trading range that we've seen for the last several weeks. And it's a really big range. We're seeing gas move more in a day or two than it usually does in an entire year. So it's just been total insanity. We actually, like, as I mentioned before, we're a brokerage service. So we have some clients that just trade online, do their own thing, but we also give them ideas, strategies and methods. We actually started in, it was probably late August, recommending bullish option spreads. But so we had the direction right, but the problem was we didn't anticipate the volatility exploding as it is. The interesting thing is the implied volatility in the options and nat gas exploded more on this particular rally than it did in 2018 or even 2014 when natural gas went much, much higher. So it's been really a challenging ordeal, but we helped clients hedge their risk with mini futures. Actually, I'm going to point that out. I don't know if any of your clients have ever thought of that, but it's been a game changer for us. There's a mini futures contract listed on the CME for natural gas. It's 1/4 the size of a regular contract. So you can imagine if let's say you have an option spread like a call ladder, which is what a lot of our clients had, where we purchased a call option and then we sold a call option out of the money, and then we sold another one above that. So it's basically like a vertical call spread with an extra call to pay for it. And of course, those extra calls really took a lot of heat in this volatility. And so what we were doing to hedge and manage risk was purchasing mini futures against it. So if the delta on your short call is 25%, you can buy a mini against it and basically get delta neutral. And that's been a lifesaver. Of course, that said, if you're going to have short option interest in a market like this, you need to have plenty of margin available to ride it out because margins increased quite a bit, and so did the stress levels.
That's fascinating. You don't see a lot of ladders going up outside of the commodity space. You don't see them as often on like a Tesla, but you do see them out there in the commodity. I'm not sure. Yeah. How did ladders become the go-to in the commodity space? Maybe it's your fault. Maybe you're the one out there spreading the ladder gospel.
Here's what it is. In commodities are the opposite of stocks. Like in the stock market or the S&P, put options tend to be priced higher than call options because in normal circumstances, the stock market drops faster and harder than it rallies, right? In commodities, it's different. Commodities tend to dribble lower, but when they go up, it's gangbusters. And so that's why people tend to do call ladders in commodities, because you can generally sell a lot of premium on the upside of the market. And in a normal market, you can get away with it as long as you're active in hedging. I mean, I'm not suggesting people that don't have experience in options go out and trade ladders with naked legs and all that kind of stuff. It takes a little bit of practice, and it's not for everybody. I'll just put it that way. But with that said, in a normal market, you can actually put together a pretty nice strategy with plenty of room for error without spending a lot of money. And it's because the call options and commodities tend to be very expensive relative to, say, the stock market, which prices calls cheaper than puts.
That's true. You get that nice skew premium in the commodities that you don't often see in a lot of the equities. So it does make it attractive to have that extra short leg, if you're right. Sometimes a bit of an aggressive rally could be interesting, but the micro products do make that a little bit more attractive. Let's see how attractive the nat gas options are out there. It's a decent week. It's actually not a blow the doors off. We've seen 400,000 contracts easily out there in a week. This week, just a tick shy of 250,000 right now on the tape, listeners. And of that, the most active is that front DECE contract that has about 20 days to go, doing almost 50%, 45.3% of the paper going up in that front DECE contract. And if you're wondering what is the vol out there, CARLEY just talking about how volatile it is. We've been talking for a while about how it's at or flirting with triple digits all the time. So even more volatile than the thing everyone thinks is the most volatile thing on the planet, which is Bitcoin, which has been shy of triple digits for most of the time. It flirts with it every now and then, but most of the time it's been below triple digits. That front DECE contract at about a 94. It's up 8.6 points from this time last week. You go out to Jan, it gets up to a 106, almost 107. That's up 5.6 points. So that ball starts creeping up. You get into February, it gets even crazier, almost 110. So it gets pretty rich. Just a little bit into the beginning of next year from a vol perspective out there. In terms of skew, like we said, the skew makes certain trades attractive out here in nat gas that you probably wouldn't put up in a traditional equity out here. Let's see what the skew is showing us this week. Not a huge evolution skew-wise this week. Last week, the puts were 9.1% cheap in the DECE contract. This week, 10.2% cheap, so a little bit cheaper. And 9.9% rich are the calls last week. This week, 8.4% rich. By the way, I should mention where we are coming into showtime at about a 5.72. It's up about a third of a point, or about 5.6% or so. So net on this week, it's actually had a bit of a run since Monday, of course, but our movers and shakers go back to the end of the show last week on Thursday. So if you expand your frame of reference back to the end of last week's show, not a huge move net for nat gas. And in terms of what the hot contracts are, remember I said we're at a 572 coming into showtime here, listeners. It was the DECE 4 puts, the 4 even puts that was dominating the tape this week with nearly 12,000 contracts. The big day was Tuesday, 3,500, almost 3,600 on Tuesday, 3,000, about 100 on Monday and Wednesday each. And most of those days looks like they were closing. So it's like someone getting the heck out of Dodge on the 4 put strike, deciding maybe we're not going to see 4 again by December. I guess not that hard to argue that one out there. Followed hot on its heels, we had number 2 were the 8 calls. Interesting. Both of those kind of out of the money contracts here. The 8 calls doing about almost 8,000 contracts this week. The busiest days were Monday and Tuesday with about 2,500 contracts each. The rest of the paper kind of scattered throughout the week, slightly opening earlier in the week. So 8, that's an interesting strike. Also, if 4 wasn't far enough out of the money for you listeners, we go a little bit farther out into March. The 3 puts were also surprisingly active, doing almost 7,500 contracts. So right on the heels of the 8 calls there, the busiest day was Wednesday, 4,200 going up on Wednesday, 2,200 on Monday, both of those days opening. So opening on the 3 puts here in March, which is interesting. And again, pretty far out of the money there. But then again, you could maybe argue perhaps maybe we'll see the inflection point by then. Maybe we'll see the bullish story start to fade away as we're getting into spring. Either way, the 3 put strike, pretty far out of the money. CARLEY, any of these option strikes surprise you, or is that perhaps what you expected out there this week?
Not shocking, but I'm glad that you mentioned the volume dropping off from a week or 2 ago. Unfortunately, I think it's a sad story. I think what we're seeing is a lot of retail speculators have been forced out. They ran out of margin money, they ran out of liquidity, or they just ran out of wherewithal mentally, because it's been a really rough ride. And as the skew shifted and the volatility went up, it really put a lot of traders in tough positions. Like, to give you an idea, we had clients that were short strangles, thinking that the vol was high when it was 80, and then of course it went up to 120, 140, which was off the charts high. But those traders really struggled because as the futures contract rallied, the calls exploded in value, but the puts didn't lose value. So a traditional strategy like a strangle didn't even work as designed. Same thing we had a lot of clients with covered calls, long futures, and short calls against it. But the calls gained more value than the futures, which really should never happen on paper. But it happened in real life because speculators were buying options and forcing implied volatility up. So it's been a really big challenge, I think. Unfortunately, we've wiped out a lot of retail specs, and I think they'll be back, but it's going to probably take some sideways action. I think the pain trade, actually, you mentioned people are buying out of the money calls and puts. I think the pain trade is for the market to trade sideways. So that's what I'm hoping we see in the next several weeks.
Shake out some of these more outlandish bets a little bit and get things a little bit more normalized. I would normally save this for our futures options feedback segment, but since we're talking nat gas right now, I'm going to bump this one up. This question comes from Meeks, one of our secret club members there. He wants to know, is nat gas a very friendly market for noobs? I have a feeling, CARLEY, what you're going to answer this with, but what are your thoughts for a newcomer? He's hearing all of this crazy action out there. Should they be diving into nat gas right now?
Absolutely not. This is even for somebody that's been doing this for a long time, this has been a really, really tough market to deal with, because things that work, like things that you read about in books that are supposed to behave one way or behaving a different way. So this is not a place for new traders. Now, if vol gets back down to 40 and things quiet down, maybe at that point you can buy cheap options and play around and do things like that. But for now, stay away.
And since we're talking about staying, let's stay in the energy complex really quickly as well. I haven't had a chance to talk about WTI on the show in a while, but it's putting up some numbers this week, even if it isn't in our movers and shakers. We did hear, of course, OPEC driving some action out there. Coming into showtime, we are seeing WTI a wee bit shy out there this week, calling it 78 and change shy. It sounds crazy. It doesn't seem like that long ago we were threatening the 30 handle, but here we are a little bit shy of the 80 handle, 78.9 or so coming into showtime, off about 4.6 handles or about 5.5%. So a decent move just this week out there. And in terms of action, also seeing a lot of action on the paper out there as well. 541,000 contracts on the tape out there in WTI. So a pretty active contract. CARLEY, when you're not out there slinging nat gas, is WTI on the radar of you or your clients these days?
We watch crude oil pretty closely. Yeah. So to be honest, I didn't, I was a little surprised to see it print up in the mid to high 80s. I thought we'd hold like high 70s. Obviously that didn't happen. But with that said, I know this is unconventional, but I think crude oil is a much better sell than it is a buy up here. We've got seasonals coming in that are bearish. We've got everybody and their dog that thinks oil's going to 100, and everybody's long. And so usually when you see the bus that loaded is when prices tend to roll over. So I'm skeptical of the crude oil rally. As far as option strategies, it's a tough market. I'd say any big rally, I mean, you don't want to do it here on a dip. That's a little dangerous. But on a big rally, let's say back up to 83, 84, if we get it, you may want to consider just risk reversals, sell deep out of the money calls, maybe, in March, and buy some deep out of the money puts. That way you're not spending a lot of premium, and see what happens. Of course, this again is not for the faint of heart, and it's not for newbies that don't understand the risk of short options. That's for sure. But just one way to play it.
I like it. I'm starting to get a sense of your strategies here, CARLEY. You like a lot of short upside. I like it. I can get behind that out there. Are you like me? Does it not seem like we were just talking about $30 and $40 crude not that long ago, CARLEY?
It's really unbelievable how fast we went from like literally swimming in oil to, wait a minute, we don't have any. So it's really stunning. Honestly, when oil, I should trust myself a lot more. When oil was at 20s and 30s, I actually charted it and said, hey, we could see 80, but I didn't really believe it would happen this fast. Even though the chart was telling me that this was possible, I doubted it and shouldn't have. So
you're right. All we heard about was gluts of oil nonstop. Yeah. It seemed like when it was in the 30 handle, there was no bid to the call wing. That was our ongoing story week after week. Nothing could cause WTI calls to catch a bid. Everyone was fading it to high heaven. And then suddenly we've had this just move to 80. So yeah, it's been interesting times.
Yeah, and I actually think we're exactly at the opposite end of that. Like back then it was lower for longer, and now everybody just assumes it's 80 to 100 like for the until the end of the world. So honestly, I think we're in the exact opposite position. I think we could see I'm gonna say it. I think we could see $40 oil by next year. We'll see.
Oh, interesting. Interesting. Yeah. I like it. Getting out on a limb a little bit. See what the options are telling us out here. Again, listeners, stay in that energy complex. Just slide the selector up to crude oil and get on into WTI. You can see exactly what's going on. Coming into showtime, like I said, we're at about a 78.90 or so right now. Decent paper. Like I said, 541,000 contracts. So OPEC driving some paper out there in WTI this week. And of that, over 500,000 contracts, just a tick under 50%, 49.7% going up in the DECE contract. That has, a whopping 12 days to go. Sounds more like an equity out here. But you know what? It's within our 2-week cutoff, but, we'll make an exception because so much paper is going up out here. 12 days is a decent enough time to sink our teeth into out here. In terms of the vol in crude oil, volatile, but not quite as volatile as, let's say, nat gas we were just talking about with a triple-digit level. Crude oil at about a 38.5. It's up about 4.8 points from this time last week. Skew-wise, let's see what our skew is telling us. Are they fading to the upside yet again? Last week, looks like they were fading a little more. 6.1% rich were the puts last week. This week, they've come in a little bit, 5.5%. The calls last week, 5.1% cheap. This week, 4.6% cheap. Not entirely surprising. We'd see a little bit of that develop just in the fact that we moved down the skew chart a little bit here. So we are lower, 5.5% lower than we were this time last week. Let's see what the most active contract was this week. And if you said 90 calls in December, you are the winner chicken dinner. The folks could not get enough of the DECE 90. So going out in 12 days, listeners, the 90 calls doing nearly 18,000 contracts. I'm going to limb and say those are probably closing, and it looks like that was the case. They traded pretty actively all week, but the big day was Tuesday. 7,400, 4,300 yesterday, and 4,300, 4,400 actually on the tape today. 1,600 on Monday. It looks like the lion's share of that was closing. So some folks perhaps maybe dialing back some of their loftier expectations for DECE, or perhaps taking off some shorts to the upside there. Either way, closing on the 90 strike here for number one, but hot on its heels. Number two, the 75 puts doing 17,500 contracts as well. Those were back and forth all week. The big day was Tuesday there as well. 6,200 contracts, most of that opening. So opening on the 75 strike, again, 12 days, we're at a 78.92 now. The 75 strike, not outside of the realm of consideration, that's for sure. Almost 6,000 going up again today. So this has been pretty active throughout most of the weekend. Looks like mostly opening out there. So opening on the 75 puts, closing on the 90 calls as we continue to move down here. And also 80 puts were also very active, doing almost 17,000 contracts as well. The big day again, Tuesday, go figure, 5,700 on Tuesday, 3,000 on Monday, 3,600 on Wednesday, and 4,400 today. So they've been active as well. These now in the money puts here in December. So a lot of put action and closing. And those, by the way, those look like they were back and forth, but slightly biased towards opening on the puts there. So closing to the upside, looks like mostly opening to the downside put side. Not exactly surprising given what we've seen out there, but also there's usually some weird paper a little bit farther afoot. Let's see if we can see any of that this week, listeners. If we go out to February of next year, the par calls, the 100 calls were pretty active, doing nearly 7,000 contracts. The big day actually today, nearly 2,000 going up today. The rest of the week pretty active as well. Looks like back and forth, mostly opening though. So opening on the par calls in February, if you want to go a little bit farther out on the skew curve and indeed on the expiration timeline there. CARLEY, any of this paper surprising you out here in WTI this week?
No, not too shocking. I can tell just on our brokerage book that there are some people willing to pay up for call premium. I tend to think that selling that premium is probably a little better trade, but only time will tell. We'll see.
We shall see indeed as we keep on rolling. Like I mentioned, one of the few names in our movers and shakers this week that actually does some options paper was the Russell 2000. So let's head on out to equities next.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everyone, welcome to the equities. Of course, we can't talk equities without first setting the table from a volatility perspective. And it has been an interesting week out there. A lot of back and forth, even if net on the week, the numbers don't show a lot of evolution out there in the vol space. Coming into the start of the show, we saw RVX, so the VIX of the Russell 2000, holding firm at around a 23. It's up about almost a point from this time last week. So RVX never really managing to break through the 20 handle, which, again, small cap structurally more volatile than large cap. So there should be a bit of a premium there. And we're seeing some movement this week. So it makes sense that that would firm up this week. VIX actually taking a bit of a break, not quite the same move in the S&P that we're seeing in small caps, obviously. So VIX shy of the 16 handle coming at showtime, about a 1590. Puts it down almost half a point from this time last week. VVIX, the vol of vol, at about 104.5. That's kind of unched from this time last week as well. So we're still holding firm right north of that triple-digit level. Vol Q, the at-the-money vol of the NASDAQ, a.k.a. the newest tradable vol product over there at CME, also holding firm at about a 17, up about 3/4 of a point from this time last week. It takes a lot to break vol Q much below that 16 handle for too long. It doesn't like to hang out there for too long. And this week, getting a lot of that juice back. And that puts that VIX to RVX spread at about a little over a 7, about a 7 point. That's pretty wide. It's actually almost 1.5 points wider than it was this time last week. A lot of that obviously coming from RVX just firming up while VIX continues to ease. The VIX to vol Q, so the NASDAQ to S&P 500 vol spread, that's a little bit more than a point, about 1.1 points. That also has widened out quite a bit. It's almost a full point wider. They were pretty much unched this time last week. They were equal to each other. So this week, getting a little bit wider out there, which is interesting to watch. CARLEY, when you're not busy slinging nat gas upside with a lot of your clients, do you pay a lot of attention to the equities? And if so, what's catching your eye out there?
We do. So we follow the equities closely. Generally don't do much with the Russell. That's kind of a wild animal. It does what it has a mind of its own. So we focus on the S&P. To be honest, I've had it. I mean, I'm old enough to know that the S&P generally doesn't behave in this type of manner. So to me, it's thrown me off a little bit. I've kind of really shied away from doing too much there, just because it's such a relentless rally with no back and fills. And so it's not really a trader's market. It's a buy and hold market. So let it be. That said, you mentioned earlier, someone mentioned Russell seasonals. I think actually it was my friend, Russell. I know Russell, but anyway, see, this time of year, you really don't want to fight the tape in the S&P. I've seen like, for example, 2008, 2009, the world is literally melting down and stocks just move up. It's just what they do this time of year. So if you're a bear, you may want to just either tread lightly or take some time off and look at it again in January.
Yeah, these are crazy times out there in the equities. And you're right, Mr. Rhodes, he may or may not be responsible for you joining us this week. He may have may have suggested you and spoke highly of you. And normally we discount what he says, but in this case, we took it to heart. Let's break it down here. Since you like the S&P, we'll start out there. Again, go to your drop-down, listeners. Go out to equities. You'll see U.S. Index E-mini. Go to the ES there at the top. That's where you'll find the S&P 500. Again, doing some paper out there this week. 46.63. These levels are just, like you said, it is kind of hard to argue against just the buy and hold these days. With every day we're in the green, it seems like up 1.5% on the week. Again, the paper out here is just through the roof. 2.55 million contracts on the tape out there in the E-mini. And of course, you know what the most active contract is. 23% going up in the contract that has 1 day to go, because that's just what equities like to do. God forbid you trade something that lasts more than a week, but that's just where the paper is. We have to go a little bit farther out, obviously, to break down the vol and the skew. So if we go out there, let's see, if we go to the week 3, November, that did about 11% of the paper this week. That has 15 days to go. So that's right at our cutoff of about 2 weeks where we like to start talking vol and skew. By the way, if you're wondering what the vol is in the E-mini right now, in the week 3 contract, 11.5. So compare that to crude oil, roughly 3x. And of course, nat gas, almost 10x. That's pretty anemic from a vol perspective out there. And of course, that's off nearly a full point this week. So, forget about what we're talking about with VIX and RVX, the actual at-the-money vol in some of these contracts, even lighter out there. In terms of what we're seeing from a skew perspective, we're starting to see that premium creep back into the puts there. Again, some of that is just the fact that we're starting from such a low baseline. It's easy to have a almost 30% premium to the puts when the vol's 11.5. But that said, we are starting to see that creep up again. 17.3% rich were the puts last week. Remember, we talked a while ago about how that put bid was kind of kicking in. That skew was getting pretty rich in the S&P. Then it kind of came in a little bit, getting rich again. It's up to almost 30%, 29.7% out there. That makes it challenging if you want to go out there and hedge right now. To buy these things because they're getting juicy, and also to have it perform well, just because you're already diving in at such a lofty skew level. The calls out there this week, they were 12.6% cheap last week. This week, 18.1% cheap. So again, kind of the polar opposite of what we're talking about in some names like NatGas and others out there these days. So interesting stuff. In terms of the number one trade out here again this week, it was the 39.10 puts. Once again, going out in a day, are dominating the tape. CARLEY, I don't know if you've noticed these. We've been talking about these on the show of lately. Someone out there is just having a ball. Looks like blasting away probably at premium on far out of the money E-mini puts. Like this week, the 39.10 puts. So you're talking 700 odd handles out of the money when they went up on Wednesday. Opening 32,100 of them, doing another 32,000 again today. So a total of 64,000 on the week. 39.75 puts also going up. So can I safely assume, CARLEY, that this is you blasting away at all these E-mini puts?
Right. Yeah. No. Actually, I hadn't noticed that. Thank you for pointing that out. That's very interesting. Yeah, that can be a very expensive strategy until it's not. But actually, I've an interesting story. I'll make it real quick. I had one of my clients back in 2008 we didn't have weekly options back then, but he would wait for like the week or 2 weeks before expiration and just blow like 10 grand on deep out of the money puts that seemed ridiculous. And one day the financial crisis came and he turned 10,000 into $500,000 in about 2 weeks. So you can burn a lot of money that way, but one day it might work. But I'd say in the long run, it's gonna be hard to come out ahead.
Yeah, it's
even if you do hit that one time.
These are interesting times when that strategy is coming back. I know when I first walked into the SPX pit many years ago on the SIBO, there were a lot of guys in the back who just lived for this. Whenever there was a bid in the book for any nonsense put, they would hit it. It's fair to say those guys would change jackets more frequently than the rest. Let's just put it that way.
I believe it.
And so it's interesting to see that this strategy is coming back. Someone maybe has rediscovered everything old is new again when it comes to trading out there. So yeah, once again, these far out of the money puts dominating the tape in the the E-mini S&P 500. Let's go on out really quickly now. We mentioned Russell 2000 small caps having a heck of a week. Let's go dive into the paper out there. Pretty active as well. Nearly 40,000 contracts on the tape right now. It's a pretty active week for no E-mini, but again, it's kind of a newer addition to the platform out there. In terms of where the small caps are right now, again, just this week up 4.25%, 23.93 is where we're hanging out right now. And of that, nearly 40,000 contracts, 27.5% going the way of the dodo tomorrow. So let's scroll a little bit farther down, see if we can find some cooler. Again, week 3, November, 15 days to go, doing about 20% of the paper this week in the Russell 2000. So we can hang out there. The vol 1970 in the week 3 November contracts, up about 1.1 or so points from this time last week. And again, a lot more juice than you're going to see in the E-mini for a lot of reasons. Small caps more volatile, and also they're moving this week. So a good combo out there. Let's see if the skew is up to the same action out here. Let's see. The puts, much more bid. That seems like that's par for the course. Last week, the puts were 6.1% rich to an already lofty, nearly 20%. This week, 12.9% bid. So puts are getting back in fashion, listeners, which again, given these lofty levels, is kind of hard to argue with. Last week, the calls were 3.6% cheap. This week, 10.8. So calls getting annihilated out there. Wow. And in terms of the most active contract, you guys are always asking us about small delta calls. This week is not the small deltas. It's week 3 November, but they're 24 halves. These aren't that small. They still have a couple of weeks to go, so they're not like these are 3 delta calls. Doing a lot of paper, nearly 1,000 contracts on the tape. A lot of that today, over half of that today. So a lot of opening paper in 24 halves in November, followed by the 2400s going out tomorrow. These could be small delta calls. They're 7 handles away right now, so another couple of ticks, and they could be in the money. So right now, they're smaller delta. They have a day to go, so they could be anything by tomorrow. Let's look really quickly any out of the money puts. Actually, I take it back. The D's 2400s were the winner this week. They outdid the 24 halves. So these are pretty much at the money calls, or pretty close to it as well. doing about 1,300 contracts this week. The lion's share of those coming up on Monday. And again, most of that opening out there. So a lot of upside call activity, which again, given the aggressive nature of the move, not exactly surprising that we're seeing that out there in small caps. So a pretty active week in small caps. We're seeing small delta calls and also larger delta calls trading out there this week. Not so much the crazy small delta puts like we're seeing in the E-mini, but intriguing stuff nonetheless. All right, we did equities. We rolled through energy. CARLEY, are there any other complexes that are lighting up your tape you want to talk about before we get to some of the listener questions?
Okay, sure. The one market that I have an eye on is treasuries. I know it's not popular because everyone's just forgotten about treasuries.
Rates. What the heck are rates?
I know, because stocks are moving. Why does anyone want to bother with treasuries? Well, that's actually, in my opinion, exactly why. Nobody's paying attention. Treasuries we think that yields are insanely low here in the U.S., but the reality is our yields are much higher than everywhere else.
I like it. So let's get out to treasuries next.
The Fed, the yield curve, inflation fears. How are they impacting options activity and volatility in your favorite interest rate products? Let's find out as we explore the world of rates.
All right, listeners, welcome to the world of rates. You know where to go on that drop down, listeners. Get out of the equities, scroll on down in the asset class to interest rates. And then there's a lot to choose from out there. We'll see where we land out there. And CARLEY, I think I know why you and Russell are so simpatico now, because whenever he comes on, he also tries to sneak rates into the conversations. That's why you two. That's why you two, I think, are such kindred spirits.
Exactly.
So what's catching your eye out there in the world of treasuries these days?
Okay, so I really like the upside in the 10-year note. What a strategy that we've been doing is basically. And an interesting thing was this actually looked a lot better a few days ago than it does now. That's par for the course. But a few days ago, the puts were insanely overpriced because the market had been basically in free fall, and everybody on television was talking about the interest rate fiasco and so on and so forth. So we like the idea, maybe not today, but if we get another dip, maybe the idea of selling March puts in the 10-year and using that premium to buy calls. That way you have unlimited upside potential. And you may have to hedge a little on the downside if we're dead wrong on the direction, but I don't think that's going to be the case. I think everybody that wanted to sell treasuries has already done it. Everyone that wanted to liquidate their investment portfolios away from treasuries and towards stocks has already done it. So I think we're going to have to at some point flip back to a more normalized portfolio allocation, and I think that'll give treasuries a big boost.
Well, they don't need a boost from a volume perspective. Even on a relatively quiet week, they're still putting up some numbers. The 10-year right now, listeners, 2.1 million contracts on the tape. So not that far behind the E-mini out here this week. So a lot of action to be found, even farther down on the old yield curve. If you're wondering, coming into showtime, we're at about 131.1 out there in the 10-year. And of that 2.1 million contracts, 48.4% going up in the DECARLEY contract. So we'll hang our hat out there. It has about 22 days to go. Again, we were just joking about somewhat anemic vol in the S&P 500. You haven't seen anything if you want anemic vol until you start going farther down the treasury curve. We're looking at a 4.05 to be precise. That's off 2/3 of a point this week. So vol came in enormously. Two-thirds of a point in the treasuries is a huge vol move, and we saw that this week out there. Vol down to an anemic 4 in the treasuries out there in the DECARLEY contract. What's going on from a skew perspective as vol just got annihilated? Well, the puts came in a little bit. The puts were 5.5% rich to the at the money this week, 4.3%. So fire sale on all your puts out there in the 10-year. The calls last week, 6.3% cheap this week, 7.6. So calls getting a little bit cheaper out there this week. And what was the most active contract? Again, there's just a ton of paper on the tape out here, but it looks like it was the 130 even puts, 1.1 points out of the money in DECARLEY that were dominating the tape with 163,000 contracts. Just to put that in perspective, listener, that's going to be almost as much as your entire metals complex combined, just in that one put strike out there in the 10-year. And the most active day was Wednesday with about 58, almost 59,000 contracts. A lot of that closing on Wednesday, but then we saw about 50,000 going up on Tuesday as well. Most of that opening. So I guess a lot of back and forth on Tuesday and Wednesday out there. 33,000 contracts on the tape today, 25,000 on Monday. It's just a tsunami of paper on this strike. This was followed hot on its heels by the 129 puts, also mostly opening throughout the week, doing 118, almost 119,000 contracts, the busiest day. Also Tuesday with about 45,000 contracts on the tape, and so on and so forth. Just a ton of paper to be found out here in the 10 years, listeners. Again, just shows you, you don't need enormous vol levels to do enormous amounts of options paper. Usually higher vol levels do equate to a little bit more paper, but in the case of the 10-year, it's not hurting the numbers, still doing over 2 million contracts at a 4 vol. Carley, is it endlessly fascinating to you, like it is to me, how anemic the vol can be in the treasuries, and it doesn't seem to impact the volume at all?
I think that's actually one of the draws. Earlier, somebody asked if natural gas was a good place for new beginning traders, and the answer was no. But the answer is yes to the 10-year note. If you're a beginning trader and you want to trade options, this is exactly where you should start. You probably can't ruin your life, unless something really horrible happens. But they're just a lot easier to manage in regards to risk reward, and the liquidity's there, so it's a great place for new traders. Yeah. And I think the interesting thing about treasuries is the vol can get really, really low in treasuries until it's not. Like if you remember March 2020, we were trading sideways for weeks, and then suddenly treasuries rallied to, wildly in a couple of days. So it's the kind of market that occasionally, if you happen to be in the right place at the right time, can pay off very nicely. And if not, you're probably not going to lose too much premium waiting around for something to happen, hopefully.
That's a good point from the noob's perspective. It isn't the most exciting market, but also it's kind of hard to get your face ripped off with a 4 ball. Right?
Exactly. Exactly. Thank you.
It's a nice counter. We get that question all the time. What's a good entry point? Obviously, equities is a good starter point for a lot of our audience who are coming from the world of equities. But if you want a little bit calmer waters, shall we say, to enter into, I think you could do worse than the 10-year. Certainly the paper is there to back it up. But speaking of what you guys should be doing, it is time to feature you folks on the show. It is time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback. Your segment, I'm laughing because one of our secret club members in the live chat made a great point. He says, you can't ruin your life with the futures. Don't tell that to the guy from the Squid Game. You're right. He did ruin his life by slinging futures. I do believe, though, he was doing equity futures out there. I don't think he was doing the 10-year. But his career could have been doing Kospi for all we know. But you're right. That is a great point. They made it sound like he was the worst guy on the planet because he was trading futures and derivatives. Oh, my goodness. Send him to the Squid Games. Speaking of Squid Games and things that are just scary and generally unpleasant, we thought, our question of the week this week out there for you guys and gals, coming hot on the heels of Halloween, we thought we'd stay in the spooky spirit this week. And, in honor of Halloween, we ask you, what do you feel is the most quote-unquote terrifying options strategy out there? Of course, if you don't see the one in our list that chills you to the bone, hit us up with some suggestions. A lot of you have. On our last show, people were suggesting naked strangles for some reason. That certainly could be one. We gave you 4 choices. We said straddles, iron condors. The name alone could be intimidating to a lot of people. Time spreads, or getting a little geeky with conversions or reversals. Carley, I will give you pride of place here. First off, if you have a vote, if one of these resonates to you, or perhaps you have your own write-in for what you think is the most terrifying strategy, have at it. And then more importantly, what do you think our audience is voting for?
I assume the audience is going to say straddles. I'm going to go with iron condors. And I know that sounds kind of insane because that's the only one that has capped risk. But iron condors make me feel trapped. Like once it's on, it's hard to get out unless everything went well. So it's just not my game.
You like a naked short leg somewhere. I'm getting a sense of how you like to trade. That's how you like to
I like
lay
to
it
be
down.
able to get in and out quickly. Like if I'm right and 2 days later everything looks great, let's just move on. With an iron condor, you really can't do that. You're kind of stuck in there. And I also like to be able to easily hedge with futures and things. I don't know. It's just the thing about trading is it's a personality game. You have to do what works with your personality. Otherwise, you're stressing yourself out and you're going to make bad decisions. So find what works for you.
That's good advice there. Let's see what our audience is spooked by. And they said time spreads, nearly 47%, 46.7% saying time spreads, followed by number 2, iron condors, 31.1%. Number 3, straddles, 15.6%. And bringing up the rear, as I thought it would, conversions reverse, a little bit more esoteric there at 6.7%. We've had a lot of fun write-ins for all kinds of weird things. But yes, I think that's a good point on the condors. If it doesn't really, none of these, if they don't fit your trading style, they could certainly be pretty terrifying or at least intimidating to you. We already answered this question here from Meets. By the way, this poll, listeners, is going to be live for about another day or so. So get at it before it ends at the end of the week. If you haven't voted, at options is the place to go to make your voice heard. Again, we already talked about the nat gas market. This one just coming in recently from Marcus. He wants to know, when are we getting a mini ETH contract? Well, you're in luck, Marcus. You got the news you wanted. Actually, I was down at FIA yesterday, my first in-person conference in a long time here in Chicago. I was busy when they announced this, but yeah, CME did just announce yesterday the launch of micro ETH futures on December 6th. So it seemed like a no-brainer. They're going to have to get a smaller ETH because the standalone ETH contract they have now, it's the 5X. It's the same issues that plagued the traditional Bitcoin futures contract out there. So the mini probably paving the way for options eventually too. It'll be good news. Also, Tim McCourt, who heads up all the crypto and equities over there at CME, coming on, I think, next week to talk about these contracts. So there you go. Who was it who wrote this in? Marcus, you're getting it on December 6th. I'm curious for you, CARLEY, not so much about the mini ETH, but obviously you guys are kind of a boutique firm. Everyone seems like they're obsessed with crypto these days. Now, of course, the new Peso Power Shares ETF has changed the game for the futures and options over there at CME. Are you getting a lot of client interest in this space right now? And have you dabbled at all in any of the crypto products out there right now?
Okay, that is an excellent question. So thus far, it's been my experience that everybody wants to talk about crypto, but when it actually comes to trading it, we're getting very little brokerage interest. Now, to be fair, our clientele is generally more option trading. They're more inclined to trade options as opposed to outright futures, or at least if they are trading futures, they're hedging with options, and that kind of eliminates Bitcoin. Bitcoin does have options, but they're just not tradable. So with that said, we don't really have a lot of people that actually trade it. They just talk about it like all day, every day. And judge, if you look at the liquidity, the bids and asks and the volume, I'd say that that's probably kind of par for the course, though. I think that as time goes on, people will get more comfortable with it and it will start to be a little more active. Especially, I happen to be a very big fan of the CME's crypto products just simply because it's a regulated exchange. It's centralized. There are rules protecting people from money. There's money protection rules. So I think anybody that is going to play crypto, I think should be doing it in the futures markets, but that's my opinion. And so I think eventually people will learn that lesson and come over.
Yeah, it is funny for a lot of the core crypto folks, all the things you just mentioned, the oversight, the regulatory, the protections, that's anathema to them. They hate it. They want this completely decentralized marketplace.
Well, they hate it until it comes back and bites them. So I don't know. We'll see.
Like we saw a couple of weeks ago, those crazy prints of Bitcoin down to 8,000 on one of those venues. I forgot which one it was. If you did that on a real exchange, maybe you could adjust that or bust that, but good luck doing that in the decentralized world of crypto. So there are some benefits, listeners, to having something that is kind of centrally cleared and listed and lit and regulated. Now, speaking of which, let's go on to this one. Another crypto question. This comes from TLZ here. TLZ wants to know, is CME planning to increase the Bitcoin futures limits, or I should say futures position limits, to prevent Peso from imploding under its own weight? Beto, whatever the columns went out there these days. This has been I never heard so many people, CARLEY, talk to me about futures position limits as I have with the launch of this ETF. All of a sudden, everyone is an expert on futures position and also futures roll. That's something very esoteric, but people are very conversant in that these days as well. Well, yeah, I plan to talk to Tim about this exact topic. It does seem like they did adjust them initially right after the launch. Of course, the ETF launched on the 19th. We did see CME adjust their futures from 2,000 limit from 2,000 to 4,000 a couple days later on the 22nd. That's the first time they've done it in a while. The last time they adjusted that position limit was way back in 2019. They went from 1,000 to 2,000 contracts. They did adjust them. That said, is that enough? I don't know. This ETF seemed like it really has captured a lot of attention. We all saw what happened with USO when it went negative and how they had to adjust the contract as a result and roll their futures positions much farther down the curve. In the case of this BITO/BITO, they also have in their prospectus, they could also, in addition to rolling farther down the curve, which is going to cause tracking issues, but also they can buy equities that quote unquote have crypto exposure. And that opens the floodgates to a bunch of stuff, which may or may not track that well to Bitcoin at the end of the day. So I don't think that conversation is over, but I think maybe for now, they put their finger in the dam for now. I'm curious for you, CARLEY. Obviously, this has been kind of the big discussion point for the last couple of weeks. What are your thoughts on this ProShares ETF and the thoughts that they're going to keep adjusting the position limits to prevent this thing from, as he puts it, imploding under its own weight?
Right. I'm going to say something that's probably unpopular, but I'm not a huge fan of ETFs pooling investor money and trading futures. Maybe I'm a little bitter because of the crude oil fiasco last year and I got burned on that. So maybe that's where it's coming from. But I feel like if people want to trade a certain product, I feel like go to the source and trade futures. The ETFs are inefficient and they cause problems. And sometimes in the case of USO, they literally blew up the futures market. I know it wasn't just that, but there was all kinds of things going on, but they certainly didn't help. So, sorry, wish I could be more optimistic.
I understand that. Certainly that event left a scar on many people, which is still very deep.
Yes,
and obviously
I still have nightmares.
Yeah, we all knew theoretically it could happen, right? But we never actually thought we'd see it. And yet there it was. And so, yes, that does raise some interesting questions about the future of this product, pun intended, out there. I wouldn't be surprised if CME didn't adjust their limits because this thing is driving so much paper out there. But again, we're going to have Tim McCourt on the show pretty soon. We'll get to put this question to him directly. All right, everybody, that music means we've come to the end of an hour flies by when we're talking about all sorts of fun in the world of futures options. CARLEY, you did an excellent job for your first outing in the hot seat. I hope you had some fun.
Thanks, Mark. Yeah, it was a good time.
Well, before we go, CARLEY, if folks are interested, they want to check out maybe some of your books, or maybe you want to check out what you folks have cooking over there in the land of DECARLEY trading, where should they go? What should they do?
So you can visit our website. It's DECARLEYtrading.com. That's DECARLEY trading.com. And honestly, even if you just want to learn a little bit more about trading, whether you trade with us or not, that's fine. We have lots of educational material on the website, videos, articles, all kinds of stuff. And if you're interested in the books, honestly, Amazon's the cheapest it always is. Just type in CARLEY Garner and you'll actually see about 10 books. Only worry about the first 3 listed. The others are old. But we hope to hear from you soon.
A prolific author over there. I like it. And check them out over there at DECARLEY Trading. That's DECARLEY trading.com to learn more. And of course, you know where to go to check out all of our reports we have throughout the show, and they're live throughout the week. CMEgroup.com/TWIFO, TWIFO, or /TWIO. This Week in Options. Both of those should work and should get you to those reports. And last but not least, certainly if you want to see, especially this week, you probably want to, what's going on in the world of small caps, how the COVID impact. They have a great COVID impact hub over there on the equity markets, as well as all the data on volatility and everything else going on in the world of small caps. You know where to go. FTSERussell.com, FTSERussell.com is the place to go. Give them a follow on the old Twitters while you're at it, at FTSE Russell. A lot of great data coming out throughout the week, not just on Showtime. That's going to do it for us today. Of course, we're back again tomorrow, noon Central, 1 p.m. Eastern with volatility views. And after that, for all of you Secret Club members out there, 2 p.m. Central, 3 p.m. Eastern for Options Oddities. Then we kick off another trading week on Monday with the option block all the way through to another Thursday, another episode of This Week in Futures Options. We'll see you then.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.